my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. Here is your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. An indecisive spinning top on Friday. It seems the room for manoeuvre is now getting very limited. We may soon see a possible break. Overhead we have the upper trend line currently at 118.04 of the descending wedge pattern, with the June 2018 high beyond that at 118.51. Meanwhile, the low was once again the powerful and significant 50% Fibonacci line of the June 2020 to January 2021 move at 117.58, with the lower trend line currently at 117.13 below that, and the congestion slightly further below that is the paralleling middle time, currently 116.94, of the January to May bearish Andrews pitchfork, the neckline of the August to September 2020 head and shoulders top neckline currently at 116.98, and the lesser Fibonacci level at 116.94. It's quite a lot below at the moment, though by no means insurmountable. Quick word now about how this descending wedge pattern that we're in, how it works. Well, wedge patterns can break in either direction, but they have something like a 70% chance of breaking higher. So bear that in mind. I can't give any targets as yet, but I can give an idea of the size of the move when it happens. An upwards break would be about 135 ticks on top of the broken downtrend, whilst a downwards break would be about 65 ticks off the broken lower trend line. The descending wedge pattern terminates in early September. I imagine we'll have a break before then. One final point, beware of false breaks with this wedge and wedges generally. They are really quite common, so please treat all attempted moves with caution. That includes pullbacks. Now, so far today, move up to test the upper wedge trend line, but then halted by that very same trend line. Cable, aka sterling against the US dollar. Not quite a bearish dark cloud cover pattern here on Friday, but a market that was nicely bracketed topside by the declining short moving average currently at 137.85 and below by the gently rising long moving average currently 137.23. The market continues to try and re-establish itself over the rising long moving average, but is having issues getting over that short moving average. This is just in front of the important June to date downtrend currently at 138.19. which is the seemingly far stronger rolling resistance. Meanwhile, I've retired the idea of a move down since the start of June being a possible bearish measured move lower. Recent action also halts the idea put forward last month of a very large Adam and Eve type double top formed over the whole of this year. However, this option is just halted and the option actually is still there. It will be all depending if we have consecutive closes below the interesting 61.8% Fibonacci of the whole of the 2016 action on 136.54. This actually looks like an ad hoc neckline in practice. Finally, as a counter to all this bearishness, I would remind you all about my words from last week on how this was the first challenge to the long moving average since September 2020. Please note that challenge back in September last year was unsuccessful. Now, so far today, still seemingly squeezed in between the overhead downtrend and the long moving average below. There is still a possibility, a faint one, that the long moving average may become some sort of attractor for the market. Euro sterling. A very small bullish white soldier on Friday. Could be seen as a possible day 2 in a 2-day bearish inverted hammer pattern. Now, these patterns are quite interesting, as traditionally they are seen as bullish. However, data indicates that they are bearish nearly 7 out of 10 times. So it'll be interesting to see if the market follows tradition or the data. Overall, the market has made a second consecutive close, back down below the medium moving average, currently 86.01, and the short medium moving average, currently 85.86, and back down below the top of the May to date based bear channel, currently that's 84.78 up to 85.67. Well, below the lower bear channel line, we have the support at 84.69. Now, this support had originally halted the decline back in April. Now, in the last week of July, we are already set for a possible monthly key reversal. If we close on Friday either over 8600 or under 85.70, then we'd be on. Anything in between would have a lesser outside month. So close of business Friday, we were looking at a monthly key reversal down, if only just. Now so far today, a rise up to test the capping upper bear channel line and then back down to Friday's low. US dollar against the Indian rupee. A case for wood for the trees. If you don't know what I mean, it was whilst I was busy looking at the effect of the market was having on the ascending broadening wedge pattern formed over June and July, I didn't notice that on Friday we were also on for a weekly key reversal. That's duly happened, and last week was a weekly key reversal down, even if Friday was also an indecisive spinning top. It could also be seen as a bearish engulfing pattern. All this follows on from last Tuesday and Wednesday's two-day pattern of a bearish inverted hammer. With Friday, we now have two consecutive days below the lower trend line of the recent mid-June to date ascending broadening wedge pattern. Whilst there's still a real chance of a false break lower, or even a pullback up followed by a renewed attempt lower, I still feel it appropriate to give an idea of the possible targets on the downside. Initial target X will be in the 74.05 area, whilst the further secondary target X1 will be in the 73.80 area. Now, on the way down, it would have to negotiate the 50% Fibonacci line of February to April 2020 move at 74.26, as well as some late June congestion between 74.10 and 74.20. However, and it is a big however, wedge patterns are very prone to false breaks. And as I've already mentioned, they have pullback issues, in that they may drop down, pull back up, quite a bit actually, give the impression of a false break, and then drop down for a real move lower at a later time. Hence great caution on how you react, as all may not be as it seems at first glance. So far today, well, nothing that much, surprisingly. The market's staying where it has been these last 3 working days, and indecisive again to boot. US dollar against the Brazilian real. After last Thursday's superficial indecisive spinning top, which on close inspection turned out to be a reactionary bullish harami, well, Friday also became an enigma. An indecisive doji cross that by only a few ticks was also a key reversal up, if only just. The close was capped once again by the breach but still potent descending upper tine, currently at 520.08 of the late May to early July bearish Andrews pitchfork. I've been wondering last week if this pitchfork will last the week. Well, it has just about done so, but at no major credit to itself. Meanwhile below, we still have the flatlining short medium moving average currently at 514.11 and the rising short moving average currently 515.56. Normally I would not mention the short moving average, but it played an invaluable role in halting and turning the market back up 2 weeks ago. So it is well worth a mention. Overall, we still have the argument I outlined 2 weeks prior for the late June to date action being a bull flag. But for me, it is getting thinner and thinner each day. You see, you could as easily argue the July action as the double top, which is beginning to make more sense. But it all needs time. This all is in the shadow of the remarkable number of dead crosses we've seen here since late May. It all now depends on whether the bearish Andrews pitchfork will finally reassert its hold. Beyond it, on the top side, we have the declining medium moving average, currently 533.05, and the long moving average, currently 535.59, both now entering the frame. US dollar against the Mexican peso. A third bearish black crow on Friday, as the market finally moved away from the overhead dynamic declining overhead resistances of the medium moving average, currently at 20.10.03, and the long moving average, currently 20.17.74. However, the downside was limited by the flatlining short medium moving average, currently at 19.97.26, with the help of the gently rising short moving average, currently 19.97.19. Overall, this still hasn't taken us away from the extensive indecision we've seen previously in this market. Indecision that stretches from the fall back to these levels originally seen in mid-April, but which recently started again in late June. Overall, the adherence of the market to the gently declining neckline of the February to March head and shoulders top, currently 19.86.35, is still indicative of this neckline acting as an attractor to the market. Further below we have the April to May base congestion zone between 1985 and 1995, with the neckline lower still, currently 1960-17 of the late January to mid-May head and shoulder stop acting as further support. So far today, a slightly higher open and then a move up to the overhead congestion of the medium and long moving averages, passing through the medium but getting caught by the long moving average. Prices have since dropped back towards where they started today. Continues to look like these two declining moving averages are exerting a continuing bearish impact overall. Thank you for listening. This short version broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Service International Limited. And here comes the final bit.